It is almost 11 a.m. in Singapore and Shanghai. Welcome to Bloomberg Markets Asia. I'm Haslinda Amin. Here are the top stories. Asian stocks struggling for traction as markets await a fresh catalyst, with the results coming up from AI poster child NVIDIA. The Kiwi jumping with government bond yields as the RBNZ signals rate cuts may be delayed to later in 2025. And Paytm's fourth quarter loss set to widen after the RBI cracked down on its banking affiliate. The stock's down more than 60% in 6 months. Let's do a check-in on how markets are faring with Avril Hong. And Avril, markets down for a second day in Asia. It is about NVIDIA, and trade is bracing for perhaps more vol, depending on how NVIDIA performs.
Yeah, it is all about this marquee earnings event of the week. But ahead of that, you can see there's really equities struggle for traction and not seeing that much of direction at all as the anticipation builds for what we're going to see from the poster child of artificial intelligence. Remember, the bar is really, really high. Ahead of all that, what we have for markets is the digestion of a bit of the Fed speak. We're seeing the Japanese equities underperforming, though, because we did get some trade data. It showed a trade deficit in the country, and it shows you how the weak yen is really weighing into the value of imports, perhaps complicating things further for the Bank of Japan. Taiwan is outperforming, but as I say, it's really about NVIDIA, which begs the question, the extent in which, if we see an earnings upward surprise, whether this is going to impact the broader market. And we heard from Morgan Stanley's chief U.S. equity strategist weighing in on this. Have a listen.
AI is everywhere except in the numbers. NVIDIA has been the big winner so far. There haven't been a lot of other big winners on the spend. There's a lot of spending going on, but it hasn't trickled down in a way that's rising the whole tide, right? So there's a lot of AI dollars out there, and they're being captured by various businesses. But what's been surprising to me is that the overall IT spending is sort of flattish to down.
Now we're seeing Asia's chip makers mostly in the green. Perhaps that optimism that we're going to see that lift coming through from NVIDIA, the likes of SK Hynix and Taiwan Semiconductor. Now let's flip the board, because the other big thing that we're watching today in terms of monetary policy is the RBNZ, which came through with a hold. But what surprised perhaps some corners of the market was that more hawkish than anticipated signaling. It shows how the RBNZ is really focused on fighting inflation after that upward surprise in the first quarter. The RBNZ's forecast now show the easing only in the third quarter, not the second quarter of next year. And it even discussed rate hikes at its most recent meeting. So more hawkish messaging than anticipated by markets. You can see the impact on bonds already. The Kiwi is also jumping against the Aussie dollar as well as the greenback, Haas.
That's right. The Kiwi up 3.5% this month alone. Avril Hong, thank you so much for that. Let's put it all in perspective. Our next guest believes a cooling New Zealand economy would be able to see inflation moderating in the coming months. Let's bring in Grace Tam, Chief Investment Advisor at BNP Paribas Wealth Management in Hong Kong. Good to have you with us, Grace. So are you in line with what the RBNZ is saying, that cuts could come only in late 2025?
Yeah, I think for the RBNZ, obviously for the mandate is actually solely focused on inflation. So the sticky inflation, especially in the first quarter, has made them like on the hawkish tone. And for today, I think they already hinted the rate cut will be delayed to next year because they need more time to see the inflation to go down. And obviously with the economy already in a technical recession, we do also see chance for the cooling economies to to see moderate inflations in coming months, if not quarters.
We have the RBNZ Governor, Adrian Orr, giving a press conference as we speak. Grace, what does it all mean for the Kiwi dollar, its surge versus the USD versus the Aussie, up 3.5% this month alone? How much more upside is there to the currency?
Yeah, I think for both ROB, NC, and also like the Reserve Bank of Australia, the minutes also revealed that the committee discussed about the chance of even a rate high. But so I think for both central banks, for now they are on a hot cage hole, and obviously I think investors will focus on the potential interest rate differentials, especially versus the Fed. And for the Fed, we think for now the base case for us is to start cutting in September. So, but for the Reserve Bank of Australia and also the Reserve Bank of New Zealand, is very likely they're going to delay to next year. So I think this actually could be actually supportive for the Aussie and also the Kiwi in the short term, given the Fed will still cutting rate before the both Asian Pacific central banks. Yeah.
We heard Fed Waller saying that there's likely to be one cut this year. I'm just wondering, with the Fed pushing back on his rate cuts, might the other Asian central banks do the same? Apart from the RBNZ, which push it back to 2025, who else might do the same?
Yeah, I think for now, especially when you look at other Asian central bank, for example, Bank of Indonesia, they even hike interest rate last time, given the concerns of the weakening in terms of their currencies. I think for all the Asian central banks, they will be pretty cautious. Even they have been seeing inflation could be toning down. But I think they're still cautious that the delay in terms of the Fed rate cuts could see more outflows for their local currencies. So I do believe they will be pretty cautious. For example, for the Bank of Korea, for the upcoming meetings, we actually expect they will put on hold, despite we also forecast that they may be able to raise the GDP forecast, but I think they will be really cautious in terms of the tone. Yeah.
Grace, we've seen such a fantastic run in terms of the stock market, the S&P rising for more than 300 days. I'm just wondering, when will higher for longer start impacting market sentiment?
I think for now, even for a lot of Fed speakers coming out talking about the higher for longers, but I think the broad message is still the rate cut is still on the cards this year, but the timing is not certain because everything is data dependent. So I think with these expectations, we've been seeing for example, the U.S. Treasury 10-year yields actually is in range bound, right, from 4.3% to 4.7%. So I think for now, given the yields at this kind of range bound trading range, it is actually supportive for the equity markets, unless if there is risk that inflation is getting back even out of controls and there's chance for the Fed to hike rate. I think this is the scenario that the market has not priced in, but this is also not our base case scenario for now.
In terms of how your portfolio should be looking like, Grace, how should it be? Take a look at bonds, for instance. Not too long ago, longer-dated treasuries were pretty appealing, but not so at the moment. How are you playing the bond market?
Yeah, I think we still prefer the short duration investment grade bonds, given, I mean, there's still chance for the yields to go up, because, I mean, it is really depends on the inflation numbers or the labor market numbers, and so we kind of expect range bound for yields, and that's why for now we're still thinking like prefer the short duration investment grade bond. Yeah.
And of course, for the stock market, it is about NVIDIA. Max 7 pretty much have been driving that rally that we've seen so far. What are you anticipating, and can NVIDIA sustain the rally that we've seen so far?
Yeah, and of course, for now, the market consensus for the sales growth of NVIDIA is actually really high. It's like over 240%, and a lot of like good news or expectations actually already pricing, given the share prices jump ahead of the results. So the bar, of course, is very high, and whether, I mean, the party can go on really depends on how the results can beat the consensus expectations. So it's not easy, because it's really already high expectation. But in terms of like playing the theme of AI, we still think AI is a multi-year structural theme, and it's more than just the Magnificent Seven. There are like software, cybersecurity, cloud computing. They're all actually related to the AI themes. So we actually prefer to play the AI themes from a more diversified approach.
Have you been gaining exposure in these AI themes? What are some of your latest moves in that space, Grace?
Yeah, we still like the related sectors, for example, like softwares, we like cybersecurities, and also like the semiconductors in Asia.
And Grace, before we let you go, commodities having quite a run as well. We have copper, gold, silver, all surging ahead, hovering at record highs. Can those gains be sustained?
Yeah, I think especially with the sharp rise recently because of the concerns, I mean, especially in the Middle East, tensions, etc. But there could be like consolidation in the near term. But like I mean, for longer term, we actually still like, for example, like gold, silver, and the other commodities. And in terms of like copper, we still like copper in the near term, but it also depends on the recovery in China. I think recently there may be like more momentum, more like stimulus measures coming through, but there also some disappointment that the measures, for example, in the property sectors is actually falling short of expectations. So I think like for copper prices, maybe in the in the near term, we could see some like volatility. Yeah.
Grace Tom, BNP Paribas Wealth Management in Hong Kong, we thank you so much for joining us. Now, still ahead this hour, our exclusive conversation with the CFO of Southeast Asian property tech firm Property Guru. We'll discuss what's next for the company after their net loss narrowed in the first quarter. But first, investigations begin after severe turbulence hits a Singapore Airlines flight, killing one passenger and injuring dozens more. An update just slightly later. And of course, in New Zealand, we have RBNZ's Governor, Adrian Orr, saying that he is confident the RBNZ will get to its inflation target. We'll get you the latest lines from that press conference in Wellington. Keep it here with us. This is Bloomberg. Welcome back. Singapore's Transport Ministry is investigating after one person was killed and dozens of others injured when a Singapore Airlines flight from the UK hit severe turbulence. Bloomberg's Avril Hung is tracking developments for us. Avril, of course, this is a developing story. What do we know?
Yeah, it's a really unfortunate incident. We're hearing how Singapore's transport authorities are in touch with their Thai counterparts. They're sending investigators to Bangkok, which is where the flight made an emergency landing. The Civil Aviation Authority of Thailand is also investigating. Singapore Airlines says is working with authorities. This was a flight that had more than 200 people on board, and they came from multiple nationalities, the UK, Australia, Singapore, India, and it was supposed to be a very routine, uneventful flight from London's Heathrow Airport to Singapore's Changi Airport, 13-hour journey. But it was over the Irrawaddy Basin, Singapore Airlines says, where it hit severe turbulence. The passengers described being in their seats at one moment and then hitting the overhead compartments in the next, and items just strewn, as you can see if you take a look at some of the social media videos all over the cabin. So a really unfortunate and traumatic experience. I think we have heard how one British national was confirmed dead. He's a man in his 70s, and it's suspected that he suffered a heart attack. Has.
We know that turbulence is pretty common when you fly, but the extent of this turbulence was pretty rare. What caused it?
Yeah, it's unclear what sort of turbulence this was exactly, but we do know that in general turbulence can be caused by rising pockets of hot air or from clouds via gusts and storms. But the more extreme cases can come in the form of what's known as clear air turbulence. This occurs and tends to occur at higher altitudes when you have a difference in speed between two air masses, and the flight is thought to have been traveling at an altitude of about 37,000 feet when this incident occurred, which is really high up in the air. So that's what we know so far in terms of what sort of turbulence might have caused this incident.
We know that climate change is increasingly impacting this space as well. I mean, do we know how might this have played out?
Yeah, it's really difficult to pinpoint when it comes to whether there was a direct impact from climate change and this particular incident, just because the data is not very cohesive or out there. A lot of the times it's highly dependent on the records from pilots, but atmospheric scientists have already flagged that if they're looking at data from the 1970s till now, in the North Atlantic, for example, there has been a surge of about 50% in terms of clear air turbulence incidents, and they think that going forward into the decades ahead, this could double, triple severe turbulence. But even without the direct links or not knowing for sure whether it's climate change related, we are already seeing how this is potentially affecting things on the ground even before takeoff. You think about how extreme heat in instances where that's affecting whether the plane can even take off, much less stay afloat as intended, because you think about how hot air is less dense than cold air, these molecules really bouncing about. That really complicates things. So even then, air travel is already, perhaps being disrupted in a way by extreme heat. Has.
Get ready for delays, I suppose, when we travel. Avril Hong, thank you so much for that update. Now, still to come, China's economic miracle is ending, leaving President Xi Jinping with a challenge none of his predecessors faced. More in a big take next. Keep it here with us. This is Bloomberg. Welcome back. After 4 decades of unparalleled gains in income and wealth, China has been hit by a series of blows, including a real estate collapse and a trade war with the US. This is presenting a unique problem for President Xi Jinping, who, unlike his predecessors, cannot bank on economic strength to underpin support. Joining us now is Wan Ha, who hosts our new Big Take Asia podcast. Wan, I know it's hard, for a man like Xi Jinping to govern a country at the end of an economic boom. What are some of the key takeaways here?
Yeah, I mean, you know, this great reporting by reporters. I mean, they spoke to a wide variety of people, everyone from stockbrokers to window washers. And what we're seeing is that, you know, people are feeling less secure about their futures, right? And this is a new reality for many, many Chinese that they've never felt before. I mean, obviously, what you said. I mean, you know, this is unparalleled in that we're seeing President Xi Jinping rule post-boom. I mean, it's obvious, it's evident that China's, you know, economic miracle of you know, big, huge gains, economic wealth are over, right? Certainly the momentum is fading. So how do you govern post-boom? And that's been really difficult. But for people on the ground, even though, you know, you can say your gains, actually, your income gains are actually, you know, fairly healthy by worldwide standards, tell that to a Chinese family on the ground. They're not feeling that. They're not feeling optimistic about their future.
You're talking about on the ground. Is it stirring discontent? What are we seeing on the ground?
That's right. One of the stories that really resonated with me is the story of Mr. Huang, right? He is a businessman who sells energy contracts to factories. And he's saying that in the last few years, that's been really difficult. You know, in the last 10 years, he's been feeling very hopeful. He's had a fairly cushy life. You know, he had a great business. It enabled him to buy a nice apartment in Shenzhen, a brand new Tesla. And now he's saying this apartment has lost its value. I'm seeing friends not even having kids because they're struggling so much. And of course, within his own business, it's like he's seeing these factories really want to nickel and dime him, negotiate so thinly on his profits. And that's been really difficult. They don't even want to commit to longer term contracts anymore. So of course, the result is he's actually had to lay off workers. So that story really resonates. And I think that's a story that's being now repeated across you know, China. And people just are not feeling very hopeful.
And that is impacting consumption. We know that lots of Chinese are now saving up their money more than spending it. I'm just wondering, how does the government, how does Xi Jinping overcome this problem? How is the leadership dealing with it?
I mean, those are really good questions. And of course, the biggest question, of course, is what does this mean for that unspoken social contract that Xi Jinping, the Communist Party, has had with the Chinese people for so many years, right? And that contract essentially is you give us, you know, control and you give up political and social freedom. And in exchange, we give you prosperity. And now, of course, that contract is fraying. And, you know, what we're seeing as a result is a lot of more control. You know, there's much more surveillance in China, lots of CCTV cameras everywhere. You've got even security, you know, police now trolling on WeChat and controlling that. So people are feeling, you know, obviously very, very, you know, difficult situation, and they're feeling just not as comfortable, certainly less optimistic.
That's right. Common prosperity. What does it mean? How will this play out? Wan He, who hosts our new Big Take Asia podcast. For more on how China is navigating the slowdown in its economy, read Bloomberg's Big Take on the terminal. NI Big Take is your function. And as we mentioned, the Big Take Asia podcast is out today on iHeartRadio, Apple Podcasts, and Spotify. New episodes drop every Wednesday. And of course, it's the big RBNZ day today. It is hosting its Governor Orr is having his press conference right now, and one of the lines coming out of that press conference is that raising rates was a real consideration for this particular meeting. Of course, Adrian Orr kept rates unchanged today. Raising rates was a real consideration. The question is whether tax cuts are physically needed at this point in time as well. Now, still ahead, Property Guru reporting a narrower net loss in the first quarter thanks to strong results from Singapore. The CFO will be joining us for an exclusive interview in just a moment. Keep it here with us. This is Bloomberg. Welcome back. China markets just heading to lunch. Taking a look where we are in terms of the CSI 300 index, just managed to eke out some gains on a day when Asia is in negative territory, adding to what has been a rally since January. We know that we've seen the MSCI China index surging about 29% in that period, about 50% of its members trading above the 200 DMA. So talk about a reversal of fortune. In terms of where we are in positives of the yuan. 723.92 is the level we're looking at. Of course, when you talk to traders, they say that that rally is pretty much broadening with greater investor confidence in Chinese shares, cheap valuations, China's policy support also helping with those gains. And HSBC, Goldman among those that say that gains may continue in the coming months. So CSI 300 just managing to eke out some gains to be in the positive at this point in time. Question is, can it maintain that gain today? Now, Bloomberg has learned that Taiwan's TSMC is among companies that have ways to disable the world's top chip-making machines in an emergency scenario such as China invading the island. Let's get more on the scoop from China economy editor James Mager in Beijing. James, tell us more.
So what our story yesterday said was that ASML, the company that makes these lithography machines that TSMC and other chip makers use to make semiconductors, has ways to disable them remotely. So some kind of kill switch which allows them to turn off the machine and make it inoperable from a distance. And obviously this is a topic because there is growing US concerns about an invasion of Taiwan, and if Taiwan was invaded by China, theoretically the Chinese could then take over TSMC's chip factories and use those to make the highest or the most high-tech semiconductors. I think stepping back a little bit, if you think about in what kind of scenario this would actually become reality, if China was to invade Taiwan, I think who has control of TSMC's factories would be quite far down the pecking order of things we would be worried about at that time. For people like me personally in China, and just more broadly for the global economy, that would be such a massive shock to the global economy and such a massive upheaval, and also would just be massively disruptive and destructive to people's lives in Taiwan. So thinking about what would happen to the factories and what would happen to the lithography machines in those factories in Taiwan sort of seems a little bit less important than how many people in Taiwan would die in such a scenario. How would those factories even exist after hundreds of thousands of missiles and bombs have been flung at the island? But I guess this is allaying some of the concerns of the U.S. government that if necessary, ASML would be able to shut down access to those machines.
So what do we make of the possibility of government intervention to prevent the technology getting into the wrong hands?
I think if you look at the global supply chain for the semiconductor, there is a lot of different points of failure, and I think this kill switch in these machines is just one of those points of failure. So if China was to take over the island of Taiwan, all of the suppliers for TSMC, not just ASML, but Japanese companies like Tokyo Electron, you have Nikon, you have Canon, you have Lam and Applied Materials in the US, you have Korean companies. All of those suppliers are going to stop supplying TSMC and AMC and the other chip companies in Taiwan with the equipment, with the chemicals necessary to make semiconductors. And so they're not going to send their engineers to maintain those machines. They're not going to send the chemicals and the various different the silicon wafers to be turned into semiconductors. And so there are many points of failure where specific governments could intervene in the process of making semiconductors if they thought it necessary. And if China was to invade Taiwan, I don't think any Japanese company or Korean company or US company is going to be sending their engineers or sending their products to Taiwan, even if the Chinese or the company that took that over took over TSMC's factories in Taiwan wanted that. So there is lots of points at which governments around the world could and would intervene in the production process for semiconductors if a nightmare scenario like this happened. I think this kill switch that we reported on yesterday is just one of those.
Fascinating story and a great scoop. Bloomberg China economy editor James Mager in Beijing. Thank you so much for that. Now, Southeast Asian property tech firm Property Guru narrowed its net loss in the first quarter. Total revenue rose 12% on the back of a strong growth in its Singapore marketplace segment. Marketplace's revenue increased 13% as Singapore offset a slower recovery in Vietnam as well as Malaysia. Let's bring in the company's CFO, Joe Dish. Joe, good to have you with us. Not a great set of numbers. I qualify that because we saw a drop in the stock price. I mean, can we expect better numbers ahead, better quarters ahead?
First of all, thank you very much for having me on. It's great to be here. Look, we're really pleased with our results. For us, double-digit revenue growth, We saw flat costs. We also therefore saw a double-digit EBITDA margin. We're seeing really good performance from our Singapore business. We're seeing some recovery in Vietnam and in Malaysia, where we have had some challenges. Good product adoption, so we're actually really pleased with this set of results.
But it is about profitability in the end. What will you be doing to improve profitability? How will you manage your costs to ensure profit goes up?
Sure. Yeah, look, it depends which metric you pick. Internally, we tend to use adjusted EBITDA as our metric. It's what most of our peers use. And for that, we've seen consistently great increases in operating leverage and our capacity to raise profitability by that metric. I think our corporate costs are decreasing as a percentage of our revenue. Our revenues are rising. We're managing costs really well. So I think we'll see adjusted EBITDA continue to rise and show good leverage and reach some of the high marks of some of our global peers.
In terms of markets, Singapore was an outperformer. Thank goodness for that, because it did manage to counter the slowdown in other markets. Can that be sustained? I mean, given all the additional taxes that Singapore government is imposing on, property purchases?
Absolutely, yeah. I think
and given the high rate environment.
Yeah, absolutely. I think for us, Singapore is definitely coming off a high. It's seen a huge increase in the number of transactions and a huge increase in price over time, and that's not something that can be sustained in the long term. So at the moment, we're in an environment where the number of leads out there is a bit lower. That's actually a sweet spot for us. It's quite hard to convince agents to spend sort of more money on our site and deliver more leads when the properties are effectively selling themselves. So right now, where there's a fewer leads in market, the agents are investing in our site, in the one that delivers all their leads. So we're seeing our revenues doing very well. In terms of longer term outlook, I think Singapore is a very attractive place for people to live and work. It's an island, and sort of property in itself is in short supply. So demand will always be in excess of supply. And we think that the market will stabilise now, increase, and we'll just keep adding lots more value. And hopefully be rewarded for that.
But what's driving demand? Which pocket is it? Is it the Lux segment that is driving demand in Singapore?
Yeah, I think that the Lux sector is probably a little more depressed. Obviously, some of the stamp duty changes doesn't encourage overseas buyers or certain overseas buyers to come in. I think what we find is that most demand is really domestic. It's not really international people who are coming in to buy. It's domestic, and I think your average Singaporean, feels relatively good at the moment. Prosperity is quite strong. Singaporeans, in my experience, are, I wouldn't say obsessed, but they're super focused on property ownership as part of their sort of life journey. So I think they'll continue to buy property and invest for them and their children.
But increasingly, Singaporeans are feeling squeezed because costs are high. The same situation in Malaysia, where there is a property overhang. Yeah. What do you see that play? How do you see that playing out for the rest of 2024?
Yeah, sure. I think Malaysia has its own interesting set of problems. Obviously, there's been a bit of instability from a government and a government policy point of view. There is that oversupply. There was probably too much building at the higher end and not enough at the middle and sort of lower end of prices. But the oversupply is edging down now, which is really encouraging for us. And I think we do see some positives. There's a lot of investment in infrastructure, particularly the links between Johor and Singapore. So that's really encouraging as well. We're seeing interest rates drop. We did a recent customer sentiment survey. I think 1 in 3 Malaysians are expecting to buy a property or move property in the next 2 years, despite sort of changes in price. So I think we see a much more positive outlook for the Malaysian economy and the property industry going forward.
It doesn't change the picture that most people think that property in Malaysia is unaffordable. Are you seeing more people renting versus buying property?
Yeah, sure. I think that's been a trend actually we've noticed across many of our markets. So in Singapore as well, we've certainly noticed many more rental listings going up over time. And I think, for some people who are unsure about the state of the property market, and for people who are sort of sitting on the fence at the moment, I think it's quite a good option for them to rent, to see how prices are moving, and when interest rates drop, they can jump in and be more aggressive on that side. So we're definitely seeing more interest in renting generally.
And of course, you're a regional player. That includes the likes of Thailand, Vietnam. How are these markets doing in comparison?
Yeah, look, Vietnam, I always say Vietnam is our most exciting market, and I hope as it recovers from some challenges, it's going to really sort of prove that. So we had a lot of government intervention, which was definitely a headwind for us. So they pushed interest rates up, made it really hard for people to actually gain a loan, and there was a lot of issues around developers and them being able to take bonds, etc. Since then, that government policy is totally reversed. The developers are doing better. Interest rates are at sort of the lows not seen for a long time. So we're starting to see a lot more consumer interest, and our customers, the agents, are definitely getting more active. So, we are forecasting a recovery. I don't have a crystal ball as quite how quickly that's going to happen, but we're really positive for the rest of this year. And then in the longer term, Vietnam really benefiting from the sort of the decoupling between China and the US. And it's a strong economy, really digital, very young. So we're excited about that.
So overall positive for 2024. Joe Dish, CFO of Property Group there. Thank you so much for your time today. Now staying with Southeast Asia, Philippine telecoms company Globe is looking at opportunities in other businesses such as healthcare. That's as its core telco segment matures. CEO Ernest Koo spoke to us exclusively about the company's business strategy.
Our pivot has a lot to do with our concern about the maturing telco business. Growth all over the world as far as telco revenues have been challenged. I think it's no secret. Although we did really do very well in our mobile business in the first quarter, growing by 8%, there's this paranoia that we have that one day this will all plateau and be zero growth. And so what we have done over the years is take a look at the different assets we've built as a telco, whether it's the consumer base, the data about consumers, our marketing capabilities, and of course, our human and financial capital, and pivot that into building new businesses, one of which we've been successful at is in the fintech area, where we built GCash into the largest e-wallet in the Philippines. Our objective overall is to bring about a twofold benefit, one for our shareholders in the form of increased stakeholder value, and of course, also benefiting the Filipino people, in the case of GCash, driving financial inclusion. So we continue to do that and continue to look at different sectors like healthcare and others that we can sort of effect through digital means, which is where we have the permission to play.
Well, Ernest, Steve Engel here. Let me jump in and let's talk about your financial services. You mentioned GCash, which is sort of your e-commerce wallet, and I know Mint, which is the shortened name of your fintech side of the business. Its income contribution going from 4% up to 11%. So clearly there is that transition. But I also, because this is the China show, I'd like to know how that partnership that you inked between Mint and Ant Financial of China, I think it was in 2017. Is there a scope there as your GCash services build out and need more emphasis? What kind of relationship do you see growing with Ant Financial?
Well, we're not de-emphasizing the telco business. Let's make that clear. It is our main business. It is a very important business. It's a very healthy business. We still continue to derive 52% EBITDA margins from the telco business. It's just that the potential that was sort of promised in the 5G era has not really come about for most operators today. The use cases have been limited, and the hope is that there somewhere, somehow, maybe perhaps with the advent of AI and other edge use cases, that the need for low latency, high speed mobile connectivity will come into being. As far as revenue size, I think it's still quite a ways away. Our fintech business, while profitable and growing tremendously, is still far behind in terms of revenue. However, in market value, we think that it is quickly approaching because the multiples in that segment or in that sector are far greater than what we experience today in the telco business.
And that was Globe CEO Ernest Chu speaking exclusively to Bloomberg's David Inglis as well as Stephen Angle. And we just had Paytm, which is a company in India, out with its 4Q numbers. Net loss amounting to 5.5 billion rupees. The estimate was for a loss of 4.31 billion rupees. So it is worse than anticipated. Of course, shares in India's Paytm among the worst performing globally ahead of that earnings report. A widening loss at the travel payments platform. Paytm coming up with fourth-quarter net loss of 5.5 billion rupees, estimate of 4.31 billion rupees of net loss. So worse than anticipated. We'll have more on this just a little later. Plenty more ahead. Keep it here with us. This is Bloomberg. welcome back. Just to recap numbers from Paytm, India's Paytm, that is, fourth quarter net loss coming in at 5.5 billion rupees, which is worse than anticipated. The estimate was for a loss of 4.31 billion rupees. Of course, shares in India's Paytm are among the worst performing globally. Currently, as India starts trading, it is down by about 1%. It's been down about 61% over a period of the past 6 months, the second worst drop over that period in Bloomberg's World Index. Let's get more on Paytm results with our equities reporter, Chiranjeevi Chakraborty. CJ, good to have you with us. I mean, yet another turbulent time for the company.
Yeah, I mean, it's been quite a turbulent roller coaster ride for Paytm over the past 4 to 5 months, and these earnings are the first since those restrictions were imposed by India's central bank on its affiliate Paytm Payments Bank. And you can see, I mean, it has clearly had an impact on the earnings. Net loss is much wider than what the market was anticipating. The market was going in with an estimate about a little over 4 billion rupees in net losses. We have come in at more than 5 billion rupees. Even revenues have taken a knock. Revenues are much below what the market was expecting at 23. The reported revenues are lower than the expected revenues of 23.4 billion rupees. And now I think going ahead, what really matters is what the outlook that the company gives. Mind you, by the way, the losses are being driven by almost 2 billion rupees in write-offs related to its affiliate Paytm Payments Bank. Let's not forget that Paytm's parent or operating company, which is 197 Communication, owns a majority stake in Paytm Payments Bank. So clearly, the RBI action or the action that the RBI took earlier in the year having a very clear impact on the earnings of the company.
And speaking of that, Payments Bank investment, CJ, its impairment provision amounting to 22.7 billion Indian rupee on the back of that. What are analysts looking out for from the post-earnings call? We know from the likes of MK, for instance, they're not too optimistic. They say there's a further 16% downside from here.
Yeah, I mean, absolutely. I mean, if you look at right now, the sell-side analysts are quite negative, and that largely stems from the fact that there is a lot of uncertainty with respect to market share, with respect to retention of customers. Will the customers, existing customers who are using the current UPI handles of Paytm, will they migrate to the new handles? Let's not forget that Paytm has tied up with a number of banks to continue keep its merchandise business and other payments services keep going. So what really matters next is the amount of customers they have lost over the the course of the past few months, and also the number of merchandise outlets that they have lost, because these were some of the key drivers. And let's not forget the lending business, which was supposed to be one of the key driver for earnings going ahead in the coming years for Paytm. That has also taken a knock, and it will be interesting to see what the management has to say as to what will be the future course of action for the company. How will they return to the growth path, and how will they ensure that the customers do not abandon them and go off to their competitors?
To your point, CJ, how might the company address it? What is its growth path? What are the options?
Well, the option is to spend money. Let's not forget that Paytm did raise close to $1 billion when it, IPO'd a few years ago, and the management has indicated last year as well that they retain a lot of that cash chest. So going ahead, it is very likely that they can draw down a lot of that cash and provide a lot of incentives, a lot of cashbacks, and other sort of discounts to customers to keep them on their platform instead of losing them to their rivals. So clearly, I think they're going to have to be very aggressive going ahead to retain a lot of their customers, to win back the trust of many of the small businesses and merchandisers that they had on their platform. And I think it remains to be seen whether analysts will buy the outlook or the strategy that the management lays out. Let's not forget there have also been very many top management exits from the company, so it does give a feeling of a sinking ship. But at this point of time, I think the management remains quite resilient in that sense, that they are still hoping that they can emerge out of this crisis going ahead.
our equities reporter, CJ Chakraborty. Thank you so much for that. The very latest from Paytm, just to recap some of the numbers there. Fourth quarter net loss of 5.5 billion Indian rupee. The estimate was for a loss of 4.31 billion rupees. When it comes to impairment provisions, coming in at 2.27 billion rupees on the back of those payments, bank investment. In the broader Indian market, let's do a check on how they're doing at this point in time. Pretty tepid in the first few minutes of trade. Sensex index pretty flat, but inching in the positive territory. When it comes to the Nifty Bank Index, it is in negative territory, down 0.3%. The Indian rupee trading at 83.2675 versus the USD. Of course, the dollar a tad lower today. Now, some more stories we're tracking out of India. Economists are expecting India's central bank to pay up to 1 trillion rupees as a dividend to the federal government. That's about $12 billion and could be the highest in 5 years. The RBI makes an annual payout to the government from the surplus income it earns on investments, valuation changes on its dollar holdings, and fees from printing currency. And Bloomberg has learned that India may consider cutting bond sales this year, aided by a higher cash balance. Sources say the government is looking at multiple options to utilize its cash surplus and may cut borrowings if the response to bond buybacks doesn't improve. And there are warnings of even hotter conditions ahead as deadly heat scorches parts of the nation's north. The Weather Bureau says heat stroke risk is very high in areas including Delhi, Uttar Pradesh, and Punjab, and people should avoid spending time outside. Delhi logged its hottest temperature on record on Monday at 47.4 degrees Celsius. Ouch! Plenty more ahead. Keep it here with us. This is Bloomberg.
We invest in, buy, and own the backbone of the global economy. When the water gets delivered to your house, the road you drive on, the pipeline that brings different things to your community, the telecom towers that transmit your phone, the data center, the real estate that you live in. It's what we own and build, so it's really what drives the economy, and you don't often see our name.
Is that a good or a bad thing?
You know, it's just because we're behind the scenes, but it's big with $1 trillion of assets almost. We're behind a lot of the things of the global economy.
So being low-key, do you think it gives you strength?
We just try to be quiet and do our thing, and sometimes it helps and sometimes it doesn't. But I'd say on balance, it's been good for us.
Several things to be looking out for as we go on the day. Bank Indonesia due to make its decision later this afternoon after hiking at the last meeting to the surprise of many traders. This time, though, it is expected to stand pat, leave its key rate unchanged at 6.25% since its surprise rate hike of 25 basis point hike last month. The rupiah has been pretty range bound, so not under tremendous pressure to raise rates again. Of course, we're also keeping an eye on NVIDIA, chip stocks in particular. NVIDIA front and center. It is expected to report a 243% gain in revenue, and that's according to Wall Street estimates, but projections for the future pretty much more important for the street. SK Hynix currently up by 2.5%. TSMC also in the positive right now. In the broader market, we are having a down day for a second day in a row. That is it from Bloomberg Markets Asia.